Hello, everybody. Welcome to Friday, another Talk Money with Tom show. Happy you could come and join us today. We're doing this live here from Silicon Valley. We try to do this pretty much every Friday. We miss a few here and there. But what we're really trying to do here is just help our clients, help people that are not clients, just answer some questions that might come up. We talk about the stock market and how to invest as a retiree, how to plan in your retirement and how to, reduce taxes, tax planning. So, even if you're not retired, these things are things that you can still start to work towards. If you are retired, these are things that specifically we could do. And so anyway, that's what we do. So you can send in questions live if you'd like. You can send them into the email address that you see here on the screen, or you can actually reply to the chat on the YouTube channel, and we will see that and try to answer those questions as we go. We answer a lot of questions that come up within our client strategy sessions too. So so that's that portion. Of course, then we have this channel for a reason. We think that there's some educational areas here that are lacking, and so you can subscribe to this channel if you'd like, just to get back to it. And if you want to hit the bell button, you'll get notified when we put out new content. And of course, if you just want to meet with Eason and I and chat with us, whether you're a client or not, you can go to our book appointment button, which is on our website. The link to the website's here on the channel, and you pick out a 30-minute time to talk to Eason and I. All right. So, excuse me. I like to start off each week. Maybe we can edit that out. I like to start off each week with a summary of what I saw happening in the stock market. And it's been a really fascinating week, right? I mean, the market is up pretty substantially. They closed the government, on Wednesday.
Yep.
Market's up Wednesday. Market's up Thursday. So far today, it was barely up last time I looked, but it wasn't down. It was up a little bit. So, the impact of at least the immediate impact of the government shutdown wasn't really there, right? And I think it's because, like we talked about in the past, it just doesn't have a big impact historically.
I think the market was pretty prepared for it.
Yeah.
Most of the,
Yeah.
I think most people understood there was going to be a shutdown. It wasn't like it was unexpected.
Right. And so the basics are still there. You've got this, the positive side. You've got the AI trade and the spending being spent on AI. You've got lowering interest rates, and you've got a situation where you could have some deregulation, and all of these sides are kind of pushing the market forward. And then on the other side, of course, we've got the tariffs that could have some impact, the deportations, and really the independence of the Fed. So that's still the same. This is the teeter-totter balance. So far, obviously, the positive side's winning, right? I mean, we're seeing the stock market hit new all-time highs on a regular basis, and a big part of that is because the things that might bring the market down are actually delayed, right? So that's coming later, and normally the market's looking at that, but unfortunately, we just don't know what is delayed. What's going to actually happen? Does the Supreme Court take tariffs away? Do they have other avenues, which they do, to put up tariffs? How do those work? Do tariffs stay up? Historically, when you get this high, tariffs don't stay up. So maybe they're looking past this bump and seeing tariffs come back down because, again, normally they don't stay up, whatever it might be. Yeah. So there's the positive side is definitely winning. One of the things that also happened from this government shutdown today was supposed to be the jobs report, right?
Yeah, from the Bureau of Labor Statistics.
Yeah, and yesterday was supposed to be first-time unemployment claims, which we didn't get either. So I've been saying for a while, since they fired the head of the Bureau of Labor Statistics because they got bad numbers, that we really need to find other sources outside the government anyway to see what is happening as much as we possibly can, because now you've got to question whether or not the numbers that are coming out are real. Even if they are, you still have to question it, right, just because of the way that went down. So that's one of the problems with doing that. But so one of the things that came out today was the ADP employment report. And so this is going, there we go, so we can see the timeline. This is going back a year. And so this is a private employment, right? And it's the ADP is a payroll servicing company, actually. And this comes out in the same week, usually a day or two before the big report from the Bureau of Labor Statistics, which always comes out on a Friday. But if you look at this, the thing that strikes me very much so is it started plateauing in March, which is right when the first tariffs kind of started. Remember, it was Canada and Mexico at first. I think that was actually even in February. And then, Liberation Day and all the other things that have happened, it's flatlined. And the report that came out for last month, that just came out this week, we had 32,000 less jobs. So that was kind of a big deal because there was actually an expectation for, I think, 30 to 50,000 new jobs.
Yeah, and then they also revised August down to negative too.
Oh, they did? Okay. I didn't
Yeah.
see that part. So, yeah, and that's probably reflected in this this chart. And so that's what's happening there. The labor market is getting soft. Now, this is private employment. This probably has a lot more of the small businesses in it than the big report that comes out, which includes public companies, includes the government, right?
Yeah.
And so that's important to understand. But I think maybe the small business is the first place you want to look for impact of tariffs, in my opinion. So if this is a good report to look at. So we're seeing softness in the market, and when this report came out, the stock market went up. Right. There was other things happening. There's been a lot of positive AI news this week.
It's just reinforcing the there's going to be rate cuts for the rest of the year paradigm, and
Right.
so that's where people are kind of okay. Everything news that reinforces that thought is kind of positive for the market.
Yeah. Yeah, exactly. So that, which, there's a bad news is good news at the moment, right? Until it isn't. And we've talked about that. And so the other thing we want to watch, because now maybe we're going to miss some inflation reports because the government's closed. And we've been a little suspect of those anyway. So that's the wholesale inflation. It's the, CPI, the PCE, all these reports that we get from the government. And so this is a commodity index. I've been bringing this up for the last few weeks. Actually, this week, commodity prices, at least within this ETF, came down. Even yesterday closed slightly below that trend, back up again today a little bit. Overall trend still up, no doubt. That's pretty obvious to me. But, short-term trend this week. So this week you had, falling employment potentially from the one report we could see. Again, the market like that. They see falling commodity prices here. Market likes that, right? So you can see why this turned out to be a decent week as far as that goes. So those are some. I'm trying to keep this fairly straightforward and fairly short. Kind of the things that are really, the focus. It's labor, it's inflation, and it's AI. Right? I mean, if you're going to pick top three, and so just a quick little piece here on the AI and why people are so excited about it. So first of all, the total spending or investment last year was $252 billion, right? It's a lot of money, but that's 13 times higher than it was 10 years ago. So it's growing really quickly. And then they expected to reach $4 trillion. Okay, that's a analyst guesstimates, right? But $4 trillion in 5 years. If that actually happens, that's basically what, 16 times where we are today in 5 years. So it's obviously ramping, yeah. And so people can see that now. Whether this is something that's going to work or not, I mean, these are some pretty smart people with some companies that are very successful. They're seeing something. Yeah, they're investing in it. So I don't know. Are they all wrong? I doubt it, actually. I bet you that something comes out of this. Again, this reminds me a lot of what was going on in the dot-com time frame. So, and then what they're doing with that money is they're doing infrastructure build out, almost exclusively these massive data centers and hardware that they need to build those. And energy is a big one that fits within that because that seems to be maybe one of the bottlenecks. So we're starting to see energy companies doing really well,
Yeah, but it takes time to build energy or any kind of power generation, and so I think a lot of people are going to general people are going to feel a brunt of it.
Yeah, very much so. I think the AI has a chance to kind of soak up some of the energy cost, some of the, so much energy that everybody else still needs it and they can't build it out as it takes time to build it out. Although there are some things they're looking at that are interesting, but once those data centers are built, it's 15 to 20 billion a year to refresh the hardware. So you can see why a company like NVIDIA and these chip companies and people providing things towards these data centers are really doing well because there's the software that's going in there. There's an ecosystem here of money that's going to be done. And I guess, training AI, which is what they're going to do with these big data centers, is a $1 trillion opportunity, essentially, So it's pretty incredible. So anyway, that's why the market is doing so well. Of those three things, yeah, employment's getting worse. There's no doubt, whatever the reason is. And then look at what happens with inflation. It's been it's worse, than it was. Not a lot, but it's heading in the wrong direction. Stock market's going up because this is overdoing those two pieces, right? So there's more money coming into AI that's more exciting to people. Um, and again, I'm simplifying. There's lots of things going on, but in essence, I think those are the big three, right?
Yeah.
Right now, the capital spending going into AI is more exciting and more impactful than the parts that are, on the other side, which is inflation and labor, right? And so that has to do with what the Fed's going to be doing with it and what type of impact tariffs have, what type of impact deportations have, what type of impact inflation might have, on that side eventually, right? So uh, those aren't really manifesting themselves at a level that is enough to scare people off from getting into the stock market, right? So I think you have a pretty good run left in this thing before you might have some trouble. I wouldn't be surprised to see a 20 to 50% higher point before you get to a peak. That would have lined up pretty well with what happened in the .com arena. I would say the one caveat is we don't know the real impact. So if the impact of tariffs is really detrimental, and we can't see that yet, but what if it is, right?
Mhm.
Could be. It has been in the past, so it could be again. If the impact is deportations, or how about the independence of the Fed, right? So what happens next May? They put somebody in and start ratcheting rates down really fast, and the market doesn't like it. So there's things that are out there that are potentially in the way of that 20 to 50% run that we would have. And so that's where you want to be a little cautious, in my opinion, still, and keep some on the sidelines, just because, again, in that 2000 run, we went more than 20 to 50. It was more like 100% from where we are now. And before it really blew off and topped out, this one has these extra headwinds that weren't there. So that's kind of, for me, just looking at it historically and what I've lived through for both of these, and I remember all the downturns like they were yesterday. I remember a lot of the details. And so, you learn a lot from those. And so this one is a lot like the upside of the .com, with a few different caveats and the headwinds. Yeah. So that's kind of where I'm at. Anyway, look forward to being able to cover this again next week. But now we can get into some of our questions.
So, how does the lack of data affect the Fed's decision-making process? With the Bureau of Labor Statistics being closed for the government shutdown, basically a lot of the data points that the Fed uses, or at least the government data, such as the jobs report, CPI, PCE, those reports are basically stopped when there's no when the government is shut down.
Yeah, it's going to be interesting. First of all, we'll bring up the questionable possibility that the government reports are not exactly right, even without any intent. We've seen some really wrong, job reports across all parties. So there. Some of that stuff is more important than others, but you've got a lot of private data. You've got a lot of places they can look. They have 400 economists on staff. They have pretty much unlimited budget to try to find data and try to get data themselves. I actually don't know, how, I haven't seen any articles or followed up on this yet, but how much of the Federal Reserve has been shut down, if any, during
The
this
Federal
time period?
Reserve is
They're all
they're
separate.
independent to the budget, so they're
Oh, they're
independently
that, okay.
funded. So
Yep.
they're not affected by any kind of government shutdowns because of budget appropriations.
Yeah, I bet for the power that they have and the staffing that they have and the experience that they have, they can overcome the shortage of this, government data. And maybe it'll be a good thing because, again, I think the more you can develop resources outside of the government data in case it starts to become manipulated, the better you can be as an investor to try to see how does that match with everything else that, is private.
Yeah, there's been a pretty big proliferation of alternative data sources for a lot of different things. If you look on the internet now,
Right.
there's private proxies for inflation, jobs reports,
Yeah.
anything you can think of. There's some sort of proxy now.
There is a group, I think it's called a Billion Things or something, I've forgotten, I just ran into it recently, but what they're doing is they're tracking the prices on like hundreds of thousands of things. And so they can kind of see individually on those particular goods across that spectrum, what type of inflation we're getting. And because actually the CPI report was manipulated way back when to come in lower. because politically it looks better. And obviously, if you're a government entity, you might have to start paying higher based on what's happening with CPI. So if CPI is really 6% and you're reporting 4%, right? So that there's a couple of groups out there that have taken CPI and taken it back to the old level, and it's about right. It's quite a bit higher under the other level, and so sometimes that's what you see, right? You feel this disconnect. You go to the grocery store and they're saying, "Oh, things are only going up 2-3%." That's not what I'm seeing. When I go to the grocery store, that same bag, it just starts costing more and more, for pretty much the same thing. So. That's where finding some other sources is a good idea anyway.
Do you think with the lack of sources that the Fed is basically going to just continue down the path because they can't really get those confirmations not to continue down the path?
I think that's the most likely outcome is that, they've already decided through their dot plot, as a majority anyway, a very slim majority, but a majority nonetheless, to do 2 rate cuts this year. The one private report we just got showed a $32,000 job loss on the ADP report, and then, as you mentioned, they revised the month before August down also to negative.
It was from 54,000 positive to 3,000 negative.
Yeah, so they'll be able to see that. Chairman Powell said several times that they are thinking that this bump in inflation will be a one-time event because tariffs will be kind of a one-time event. Sounds a little like wishful thinking to me a little bit. I hope he's right. And so they've decided to use that methodology and thought process to justify lowering rates in a time frame when inflation is
There's also
going
their
up.
thought process for not raising rates, though, during the basically when there's a lot of COVID basically bills.
Well, yeah, because the inflation was transitionary, we don't need to respond to it. And so what they're doing here is not only are they not responding to inflation, they're actually lowering rates, which is even more aggressive. But they are doing so in the face of a job market that is getting soft, and it could spiral downward. So I still think they're right in the direction. I think the problem is just the speed. If you do it as fast as Trump and the new guy that he put on the board want to do, I would be really nervous about that personally. I think they need to look at it because they are. I mean, you don't want to have a situation where that catapults the stock market into the stratosphere, which then does create really high inflation.
Yeah, it can cause, and then creates a bubble situation.
Yes, it could really run, which is what happened in the 70s. And so we're kind of replicating. This is in the 70s and late 60s, they were responding to a softer labor market after inflation had come down quite a bit. They lowered rates, and we ended up with a massive problem, huge rates. They had to bring the Fed funds rates up to 19%.
Yeah, it was kind of like a death spiral.
It was, but there was a component of it that's really, really different and super important in the fact that oil went up and from $4 to $40 a barrel 10 times in 7 years. So if that happened now, you would have massive inflation. There's just no doubt about it in my mind. Even though we're less reliant upon oil than we used to be, it still would be a huge differential. So, we don't have that. And so maybe, we don't get that big bump. But I would be a little nervous if they were really, really lowering rates. Right? So anyway. Good question.
So what's caused gold to go up in value so much this year? Gold's on a pretty much a historic run. It's up around 45% on the year.
Yeah, I think it has a lot to do correlated with what you're seeing here, because I saw a chart just recently. I think for the first time in over 20 years, central banks around the world have more gold on hand or value of gold on hand than they do dollars. That just crossed over within the last quarter. And so to me, it looks like, combined with the fact that the dollar is down like 10 point something percent, versus the basket of goods over the last, might be year to date. I can't remember if that's year to date or last 12 months, but nonetheless, it's down. And so people are selling dollars and buying gold, right?
Because it holds value better.
It holds value better. There's a distrust worldwide now in the U.S. because of the tariff situation, and other issues that have happened, but certainly, that we've lost some value, and now there's not as much trade that's going to happen with some of our big trading partners, so there's less reasons to keep dollars, and so, anyway, I
Yeah,
think gold continues to go here.
yeah, especially as monetary policies become looser and looser by them cutting rates,
Right.
and then just geopolitical and like economic uncertainty. More uncertainty, people turn to what they feel is a safe asset.
Yeah.
Gold is considered one of those safe assets.
Right. Now,
Um,
unfortunately, it depends on the level of uncertainty, is what we've seen, at least in the recent past. So, like now, there's enough uncertainty to make gold move upward. People are buying it, countries are buying it, entities are buying it.
yeah.
Sovereign funds are buying it. There's, so it's not a bad thing to buy. Unfortunately, what we saw in 2008, when things really hit the fan, gold went down as much as the stock market, more or less. I mean, it came down. Everything went down. Bonds went down. All the hedges fell in 2008, and so all of that diversification that's out there. So when you really, really want it to be going up, it might not do it. You can make some money now. I don't have a problem with owning it now. Just I wouldn't overdo it because of that non-ability to hedge.
Yeah,
Right?
and you have to remember, gold's like a non-yielding asset. It's not like a
Yeah.
bond or a stock where you can have dividends, even if there's no creation of value behind a piece
Right.
of gold. If you own an ounce of gold, no matter what you do in 10 years, it's still going to be an ounce of gold.
Yeah, that's right. Yeah, there's no interest payments, dividend payments that you're going to get. Yet it's doing great because it is a storage of value, and there is enough uncertainty here that people are gathering it worldwide. And so it's not a bad thing to have in a portfolio right now, but I'd keep it smallish because it's going to act like the stock portion of your portfolio. It just might do better for a while here,
Mhm.
and might even do better than the stock market, as the volatility, if it picks up. So until everything falls apart, if that does happen. If it doesn't, I think you'll probably still see gold do pretty well. It's a good question.
So, how does a government shutdown affect the U.S. economy slash stock market? And what if there is a mass layoff of government employees because of the shutdown?
Okay, so it's two pieces. Government shutdown itself, okay. So if you think about government shutdown, everybody gets their money. If there's no layoffs,
Yeah.
right? So it's not really an economic event. At least historically, everybody's got back pay. So the same amount of money that was going to go into the economy goes into the economy. Yeah, well, that's not true. There are things that aren't replaceables. For example, there's a site right now that's tracking how much travel money is being lost globally because the government shut down. It's about 100 million a day
Yeah,
and a
'cause
billion a week.
yeah, TSA basically
Right.
slows down when
Right.
people don't want to show up for work. People have to find other jobs to make income.
Well, they're not. That's just purely government travel.
Yeah. Oh,
Government travel. So those people are closed. That's just money that was going to be spent on government travel that's not being spent on government travel. And so you wouldn't get that back, right? If they reopened,
Yeah.
everybody might get their back pay, which is great, but that commerce that would have happened during the period of time that the government was closed isn't coming back.
Mhm.
That could be all kinds of things. I mean, it could be the restaurants and all the things that are nearby, the capitals and hotels, all those types of things, just because the government isn't at full function as far as that goes. So there are some economic impacts, but all of those things in the past haven't been enough to really have any real dent in the economy to the point where the stock market fell, except for a few times, right? So we have a chart here. So if you look back in the 70s, okay, let's explain this chart. So the brown, bar is returned during the shutdown.
Mhm.
What happened, and then 1 month after is I guess we'll call it dark blue,
yeah.
and then the lighter blue is 3 months after. And so you can tell actually there's a lot of negative bars back in the 70s and early 80s. Again, there was a lot of negative stock market in that time frame
Mhm.
too. So they were having shutdowns during a period of time with high inflation and all kinds of problems that were happening, and stagflation. If you look at the last time it was down is 2018. And I think the thing that's important about that, and this is one of my concerns, is that that's when we were having tariffs, and right in that time frame, and then we're having a government shutdown. And so, that's similar to what we're having right now. And again, I do think that you can pile up enough stuff against the market to then, make it go down. And so this is one brick on the side of could make the market go down.
Mhm.
But what's happening is the AI spending, the capital spending on AI is outweighing everything else.
Hmm.
Even if it's not on a pure dollar basis, but I think it might be, it is literally just the excitement, and that drives the stock market, more than anything in these time frames. This is an excitement market. It's not about fundamentals. This is going to get more and more exciting in that regards. There's going to be less and less earnings that's needed to have a company,
Yeah, it be,
to,
uh,
to be worth $1 billion.
human nature is kind of driven by like greed and fear, and
Yeah.
so as the market gets greedier and greedier, it needs less and less to reinforce that greed.
Right. And so that's why we're probably not going to see much of an impact. We've seen up markets more or less since the government closed. We'll see if it's enough to kind of create that. But then the second piece of that is the layoffs.
Yeah.
So that's a little different. So, they've never had mass layoffs during a government shutdown that I can remember, and so that's a whole different ball of wax, because now you're putting people into unemployment, right? You're taking money out of this. You're not just paying them back pay, or you're probably paying some money in severances and whatever. But in essence, the cash flow would stop to that person that gets laid off, and they'd become more of a drain on the other side, collecting unemployment, and so the contribution to everybody who's unemployed has a harder time contributing, obviously, to the economy at the same level
Yeah,
as the people that are employed. So
Yeah, they're just trying to make it break even. They're trying
Right.
to stay afloat,
Right.
rather than like spending extra money on kind
Right.
of things that kind of generate more for the economy.
so that could have a bigger impact, although it's almost always delayed. Like everything else that we're talking about here with tariffs and deportation, everything's delayed. We're seeing some of the impacts, but if they lay off a bunch of people next week, let's say, for example, they're going to pay them severances and back pay and vacation pay and all. There's going to be a bunch of money, maybe more money than normal, floating around within that group for a little while, and so you could still have some good spending coming out of that group, and without really having an impact. The group isn't going to be big enough by themselves to have an impact. They're just going to join this other group of unemployed, but they're going to join and have some money to go. So it's the same with any layoffs. It's going to take a while before that has an economic impact, right? Just because the people still have some money until they really don't, right? If you're burning through some of your money that you got as your severance, which is be a normal scenario, you only have so much time before that's gone, right? So anyway, so that could have an impact. I don't think the size of the layoffs, even though they're calling them massive, will be enough to really kick this thing past this AI spending. It's a tug of war, and AI spending is winning right now, even with some of the problems we're having. All right, so what else we got?
So, what's the difference between the ADP and the Bureau of Labor Statistics jobs reports? Why is one considered the gold standard, the other one's just an indicator?
Yeah. Well, the ADP comes out, a day or two before, usually, the BLS. It lines up pretty well over time, it seems like. When one's high, the other one tends to be high, whatever. Not always. There's some divergences. But the one thing about the ADP at the moment that makes it somewhat more important, at least in my opinion, is just that the Bureau of Labor Statistics is compiled by the government, and they just fired the head of the BLS back in the summertime because the numbers on the jobs report was bad. And so now you got to wonder if any of these reports are going to be, completely accurate. I mean, I've said to myself several times, if I got that job and the last person got fired for coming with numbers that were too low, do I want to come up with numbers that are too low anymore? Only if I probably don't want my job. And if I want my job, then maybe, it's not just one person. It's not just it's a whole organization. It'd be really hard to do that. But there can be some, pressures and what. So that's the worry. Yeah. And
Yeah.
so ADP is private, smaller companies, private employees.
Yeah, and then BLS covers government employees, self-employed, and then agricultural sectors, which are kind of missed by the ADP.
Public companies too, huh?
I think any kind of private company ADP, as long as
Yeah.
ADP is basically a private payroll.
Oh, but I mean on the BLS, is that they cover government, public companies?
They cover the private sector too, and like
Okay.
so that they cover it too. It's just they get their data from surveys and households and paychecks, while ADP just bases off their payroll data and kind of extrapolates to the private market.
Yeah, it would be nice. It seems like the revisions from the BLS report, I mean, because, I mean, last year they revised it 800,000
Yeah.
down, right? And this year, I think the revision was even higher, wasn't it? 1 point something million
Yeah,
down. And it's like, whoa.
it's tough because you're basing it off on like surveys and stuff like that.
Right.
So you're not getting every single. Nobody can get every single point of data to get a 100% accurate number. So these all like trying within a margin of error, and so
But that margin of error recently has been like 50%, or it feels like it, right? So it makes you kind of wonder. So we're all waiting for like today's report, where everybody's going to hang on today's. Oh, we got this jobs report coming out. Oh, let's see what happens, and But it turns out like 3 months later they adjusted pretty drastically, and then a year later they adjusted potentially even more.
But even
so what were you looking at, right?
even the ADP has been adjusted like that too.
Yeah.
So
Yeah.
I think it's just it's just a symptom of the system basically. You can't really.
It's a little surprising that the market reacts as much as they do to that initial report, considering how much the revisions have been over the years, right? So, both of them have that problem, right?
Yeah.
But that's the difference between the two. And again, we're not getting the Bureau of Labor Statistics jobs report today, for example. Didn't get the first-time unemployment claims yesterday, which is another one that's looked at pretty heavily right now, because the government shut down, right? So they're going to keep on going without reports for as long as this takes, I guess. So that'd be nice to get the reports. They do say that they're going to be delayed, which will be kind of interesting. Basically, what might happen is when they open up. Last time was 35 days, right? What if we went 35 days? All of a sudden, we're going to get this deluge of past reports.
Yeah.
Yeah.
Because the betting markets say that 60% of the betting markets say there'll be a 10-day or longer shutdown.
10-day or longer,
And
60%.
then 40% is betting that is going to be 15 days or longer.
40%, okay. Yeah, I could see it going for a while, because they're not even remotely close to being in the same spot as to, on each side, from what I can see. So, we'll see. Okay, good. What's our next one?
What are the pros and cons of municipal bonds, or muni bonds as they commonly referred to?
Okay, so municipal bonds are bonds that are issued by a city, right? A state.
County.
Right? I think there's some others too, isn't it?
It could be like a bridge project.
Right,
It could be
yeah.
like it could be, a transport
Right.
organization. So like in the Bay Area, it could be VTA, a
Right.
bond for VTA.
Right. And so the big advantage of buying those is if you buy ones that are originated in your state, for example, you get both federal and state tax-free income. So if you're paying 3%, it's 3% without any tax. So maybe you're making only 4%. Oh, this one pays 4%, but this one is taxable, right? So you could make less than 3% after you pay tax, depending on your tax bracket.
Yeah, and so it's like very useful if you're a high income in the high income tax bracket, because you can kind of generate income without without taxes.
Yeah.
Which is important to.
Yeah, they'll actually pay more to you on an effective basis the more you're making. So, what they call the effective yield. So 3% is what they're offering you in a tax-free, and you look at your tax bracket and figure out your effective yield is 5.5%, and you look at the taxable market and it's paying only 4.5%, you're making more with a municipal bond because you had this, high income. And so as long as you have that, munis you can make more with the
Yeah,
muni.
and so they're great in like when you're in a high income bracket and you're also in a high tax state. So California and New York are a couple ones that have, a lot of people like to have muni bonds.
Yeah.
Further.
So what we've been talking about is really looking at, the problem with muni bonds is that they tend to go down when the stock market really falls apart, mainly because munis don't have that type of backing. Like a treasury has the government, which can print money. Munis can't print money, and there's usually, in every big downturn I can remember, some municipality is going under on some bond they have, like right at the beginning of it, San Bernardino or whatever. And so that just kind of rattles the market because, people just lost money in that particular bond potentially. So,
Yeah.
So that's where you don't want it to be part of your balance portion of your portfolio, right?
Yeah.
Treat it separately. Look at it as just income source.
Yeah, it's great though because usually they pay semi-annually, so it's a very reoccurring obligation. And they're when you buy a muni bond, if you buy a newly issued one, usually they're for 30 years. So
Yeah.
you can expect that income for a long time if you buy it. Um, that's a good thing and bad thing when they're long-term durations because you just have a credit risk. You know, there be a default on the project, or will there not be enough revenue to cover the bond? Or is there like any kind of interest risk? You know, say interest rates go way up, your muni's still keeping paying the same amount.
Yeah. So I mean, the way I'd look at it is, look, if I had, so let's say I have Social Security, maybe I have some pension, and I'm looking for another income source, you know, and I've got my other assets over here. So my other assets should be, in my opinion, set up in a portfolio where I have as much as I can afford mentally in the stock market, right? And the rest of that mixture is something that does well, especially if the stock market starts to do poorly, at least historically. So that's more your traditional bond stock portfolio. So I wouldn't put munis in that. I would take munis and open up kind of a separate area and say, okay, here's my income source. I don't really care as much about the valuation if it goes up and down. I'm going to get paid this, kind of like my pension, if I have one, kind of like Social Security, but I got this income, and maybe even throw in some higher dividend yielding stocks or stock ETFs, you know, like the Schwab one or the Vanguard one or what have you. So kind of create a little, hey, here's my whatever a month is going to come out of that. And again, they don't pay monthly, but you know, on average. And so that's another income that's coming in as, I wouldn't call it guaranteed income, but another nice source of just pure revenue. And so if you're at a high tax bracket, like a 32% tax bracket or higher, then the muni one would work. If you're at a lower tax bracket, like 24 or lower, right, then you might want to just use regular treasuries, yeah? And so regular treasuries are state tax free, which is pretty good here in California because our state tax is pretty high. And then you could also have this dividend yielding stock piece, creating a little separate kind of just, hey, here's an income source. I'm going to get $100 a month, $1,000 a month, whatever amount you want to put in there that you can afford to put in there. And so, and then I have my overall portfolio over here with my balanced stock bond piece, and I want that to grow long term because I'm probably not going to keep up with inflation with, Social Security does a decent job, but pension probably not, and my portfolio here, maybe.
Muni bonds bonds don't really keep up with inflation. No. So if inflation gets a little bit wild, muni bonds, you're stuck with your rate, whatever you are. And there's also very much a liquidity issue with any kind of single issue bond. There's going to be some sort of liquidity issue when you compare it to a treasury or any kind of like with the treasury. Any treasury compared to another treasury is very similar, but each municipality is going to be slightly different. So it's just going to be a little bit harder to sell.
Yeah. So theoretically, you look at it as an income source. I think that's the way to look at it. So you might have rental property, you might have Social Security, you might have pension. So this would be your fourth one, or maybe it's your second one. You only have Social Security or pension, and so whatever it is, right? It's another income source. And so here's where I'm getting all my income from. It might not be enough. I might have to do some systematic withdrawal out of my portfolio, but at least it's diversified income sources, which I think is important. So if the diversified portfolio over here is falling apart because the market's falling apart, at least I still have these 2, 3, 4 different income sources coming in, which will really help as far as that goes. So that's and again, you would use municipal bonds if you're 32% or above in the tax bracket. You would use maybe taxable treasuries, tax-free in the state, but treasuries if you're under that tax bracket.
Yeah,
for the same concept.
And a lot of people fall under or kind of, once they retire, their income goes way down because they don't need as much. And so when you're in your retirement, you can kind of not need to have muni bonds because you just don't have a high tax enough bracket to make it useful enough.
Yeah, so that's a great point, right? So let's say I'm earning a lot right now, but I'm retiring in 2 years. And so right now I'm in the 32 or higher % tax bracket with my money. A muni bond portfolio that could produce some income would be paying me more in this high tax bracket, but I'm retiring in 2 years. And so now I'm actually getting paid less than I could because my tax bracket's low. I'm better off in a treasury. It's just math. You can figure out which one you should be in. And so, do you buy the treasuries now knowing, hey, in 2 years I'm, going to be retired, so, and I'm going to hold these maybe for the rest of my life, type of thing?
Yeah.
So the 2 years isn't as important as the longer term. Or do I buy munis now and then switch them, right? Sell them, and there's some risk there. They could be worth less.
Yeah, so you
Right.
could think about if you're in a high tax situation, you can think about getting just a muni bond ETF for your specific state because you can get California municipal bond ETFs or a New York municipal bond ETF.
Yeah.
So you could think about getting an ETF that way you still have the liquidity
Yeah,
to kind of move
that
in
would
and out.
that would make it easier. Yep, exactly. Could still be lower than what you paid for it.
Yeah.
So if you were going to retire in 2 years, and you were in a high tax bracket, would you switch it from uni to treasury and take the risk of what fluctuation, or would you just say, heck with it, I'm just going to do the treasury now, and even though I'm going to lose a little for a couple years, I don't have to switch and take the risk?
It depends on how your bond portion of your structure is because
Well, let's just say this is totally separate. It's just the income structure. We're going to put this together with a high dividend yielding ETF.
my issue is if I'm still if I'm still working and not retiring,
Right.
I'm not thinking about income because I don't need to generate
Well,
income.
I'm just saying, so you're going to retire in 2 years.
Yeah, so
that scenario. What do
it-
you do? Do you do treasuries and switch? I mean, do you do munis and then switch to treasuries, or do you just do treasuries and ride through the 2 years?
I would just wait the 2 years and then make the switch because I don't need the income now. I wouldn't be thinking, am I required to have the income now?
Oh, well, that's a good point. You just don't do it at all
Yeah.
prior to doing it.
And
Maybe.
Because like if I'm
I
working.
guess I would have to then guess as to where I thought interest rates might be.
That is true.
Right. So in 2 years, if I thought interest rates are going to be lower, I'd probably try to start it now because I'm going to lock in potentially. I mean, we can make a ladder.
Yeah,
and we can, we
you
can
can
have
lock in for a
shorter
long time.
terms and
Yeah.
stuff. A 6 month, 1 year, 2 year, 4 year, 5 year, type of ladder, and maybe something even longer. So in the end, you'll kind of end up with the best rate I think you can get using a ladder. But yeah, no, it's interesting. These are the types of things we think about all the time, and every situation is different, and you've got different scenarios that are outside of that. I was trying to create a bubble around that scenario just to make the focus easier, but
There's
that's
so many
not that's
different
not that's
there's
not
so
how it
many-
normally works.
Yeah, there's so many factors. Like if you're still working, can
Right.
you just wait the 2 years and then start to generate the income rather than?
Yeah, so I think those are the types of things that I think you want, to do on your own or deal with your advisor or talk to us about. It's just, strategies and what can happen and, looking at what you want to accomplish. Sometimes people don't know what to ask, and so that's why they rely upon the advisor. But that's I guess that's the advantage of having an advisor. If you can do a lot of this yourself, but I've been doing this for almost 40 years now. It's a lot of learning to catch up on if you want to try to catch up to what I'm doing. And people can do it. I've met some people that know as much as I do, and they've been doing it probably almost as long. They were engineers working for whatever company here. I remember meeting this one guy. He used to go to Barnes & Noble back when we had those every day. And he'd sit and read all the financial press. And he was managing his little company pension, and he really liked investing. And he was really, really good at it. He had a great portfolio. But that's kind of what it takes. That's basically what we do.
You
right?
have to have a passion.
Yeah.
Those people you tend to have a passion
Right.
for this.
Right. So anyway, that's all right. That's it for today. That's great that you were able to join us today. I thought that was really fun. Again, send in questions anytime. Send them in during the week if you have something you want us to to cover in the show. We'll be happy to do that. Ask Tom, talkmoneywithtom.com. You can subscribe to the channel, hit the bell button, if you want to get notified of new content. And of course, you can schedule an appointment with Ethan and I. There's an appointment button up in the corner of our website. Looks just like that. 30 minutes in office, on the phone, video, whatever works for you. You can ask your questions directly if you'd like. We're happy to answer those. So we like to help. It's what we've been doing for a long time, and it's what this whole business is built on, and it's been something we're trying to do with the show too. All right, good. And I look forward to seeing you again next week. Thank you.